Why China just shut down paper gold trading. The battle over what counts as real money and who controls it just got a lot more interesting. At the start of the year, some investors were betting gold could hit as much as $20,000 an ounce by the end of the year. Today, gold sits closer to $4,000 an ounce. But here is the part that actually matters. On June 24th, the Industrial and Commercial Bank of China, ICBC, one of the country's biggest banks, announced it was shutting down paper gold trading for retail investors. In practice, that means on July 24th, if you are a Chinese citizen who wants to trade gold through your bank, that access gets switched off. ICBC is not alone. Postal Savings Bank of China did it first, then Ping An Bank, then China Guangfa Bank followed in June. One after another, some of China's biggest financial institutions are pulling the plug on retail gold trading. So why is China doing this? The official story is investor protection. Gold has been volatile. Spot gold hit an all-time high near $5,500 an ounce in January, then pulled back. As of this video, gold trades around $4,000 an ounce, a drop of roughly 28% from that peak. To protect retail traders from that swing, Chinese banks have raised margin requirements to 140%, a record high for the industry. A margin requirement is the collateral you need to put up to borrow money for a trade. Pushing that number above 100% means you now need more money than the position is even worth just to open it. So, the official reason is simple. Gold is volatile, retail traders are getting hurt, and the government is stepping in. The unofficial story is probably closer to what is actually happening, and it is bigger than investor protection. It is a fight over what real money is worth. Look closely at what China is actually shutting down. Not gold ownership, margin trading, leveraged deferred contracts, paper gold. In short, the speculation, the gambling on gold's price. Physical gold is untouched. People can still buy and sell the metal itself. What is being shut down is the ability to trade paper claims against gold. The theory is that gold's real price should be much higher than it currently is, and that the price has been suppressed by paper markets for decades. To get real price discovery, meaning to find out what something is actually worth, you first have to shut down the ability to gamble on it. If this theory is correct, you would expect to see China, as a nation, buying far more physical gold than usual. That is exactly what has been happening. In May of this year, China bought 163 tons of gold, the most in a single month since March 2024. It is not just China either. Central banks worldwide have been buying gold at a pace that may be as much as 15 times higher than official figures suggest. That is also why China is launching a brand new gold clearing and settlement system, one designed to make China, not London or New York, the place where gold's price actually gets set. Put it all together. Central banks quietly buying gold, governments moving to dismantle the paper markets, and a new settlement hub being built in China. It starts to form a clear picture. So today, let's dig into what might really be going on, why China is making this move now, and what it could mean for the dollar and your own portfolio. Hi, I'm Wealth Breakdown. Stick around for the finance, and stay for the story of the battle over money and gold. How paper gold actually works. To understand why shutting down China's paper gold market is such a big deal, you first need to understand what paper gold is. Here is the simplest way to explain it. Say I own a rare physical Pokemon card, the Ancient Mew, locked in my safe. It is real. There's only one of it. Now imagine I write up a certificate that says the holder is entitled to that card. I sell it to you. You are happy because you now have a claim on the card, but you never actually come to collect it. You just hold the paper. Here's the problem. Once I realize you are never going to show up and demand the physical card, what stops me from writing a second certificate and selling it to someone else? Then a third, a fourth, a 10th. Now 10 people believe they own this Mew, but there is still only one card in existence. On paper, the supply looks like 10 Mews. In reality, nothing has changed. There is still one. If the market prices the card based only on the paper floating around, the price will look like a tenth of what it should be, because as far as anyone can tell, these cards are everywhere. That is what suppressed paper supply looks like. The moment everyone shows up at once and asks for their card, the whole system collapses, because 9 out of 10 people discover their certificate is worthless. That is the simplified version of paper gold. In the major Western markets, London and COMEX in New York, most of the gold traded every single day is never physically delivered. It trades as contracts, as claims. The people trading them never intend to take delivery of a single physical bar. And just like the Mu example, that means far more claims can be written than there is actual metal sitting in the vaults. No one knows exactly how much gold exists in the world, or how much paper exists on top of it, but the general understanding is that there is dramatically more paper than physical gold, which means today's gold price is probably lower than it should be. That is how you suppress the price of an asset. Now, where is the proof? Signal 1. The price gap between physical and paper. If the world were completely transparent, and this one Mu card had exactly one certificate worth $100, the card and the certificate would trade 1 to 1, because everyone would know the full picture. But the moment nobody knows how many cards and how many claims exist, a natural price gap appears. People start paying a premium for the physical item because they no longer fully trust the paper. The tighter that spread, the more honest the market looks. The wider the spread, the more something looks off. Have we seen this kind of gap before? Yes. In the silver market, the spread between physical and paper silver spiked as high as 40% back in January. It has narrowed significantly since, but a real premium for physical silver still exists. Gold's spread today is much smaller, which in theory suggests a fairer market. But is it? China appears to want to find out by stripping away the paper speculation entirely. Signal 2. How investors are actually behaving. Here is the second signal, and it might be the stronger one. If you believed the paper gold market was inflated and the real price should be higher, you would do 2 things: sell the paper and buy the physical asset. So the question becomes, is anyone actually doing that? Yes, and it is the most sophisticated money on the planet doing it, the central banks, the very institutions that print the world's paper currencies. They have been buying physical gold at the fastest pace on record. In the first quarter of this year alone, central banks bought a net 244 tons of gold, the strongest first quarter ever recorded. And it is not a one-time event. Central banks have bought over 200 tons of gold in 10 of the last 11 quarters. A significant portion of that buying was never officially disclosed. The World Gold Council itself notes that its figures include an estimate for undisclosed purchases, meaning gold that central banks are buying but not reporting. This kind of shadow accumulation reportedly stretches back to 2022. The official numbers are likely just a floor. The real total could be several times higher, especially for China. That covers what central banks are buying. Now consider what they are selling to fund it: U.S. Treasuries. For roughly 50 years, the standard central bank playbook was the opposite of this. Extra dollars got parked in U.S. Treasuries, effectively lending that money back to the United States for a bit of interest. It was considered the safe move, and nearly every country did it. That strategy has been reversing. Foreign central banks largely stopped growing their treasury holdings over a decade ago, and some of the largest holders have been net sellers. China alone has offloaded hundreds of billions of dollars in U.S. debt and rotated the proceeds into gold, doing it gradually so as not to crash the value of its own remaining holdings. Selling a paper promise from the world's most powerful government in order to buy an asset that pays zero interest only makes sense if you no longer fully trust that promise. The old deal was simple. Hold our paper, park your money in our assets, and we will keep the system stable and fair. After the Iran conflict exposed cracks in that arrangement, and after decades of conflict funded by money that can be printed without limit, much of the world appears ready for a different arrangement, one economists sometimes call multipolarity, where power and trust are spread across several nations rather than concentrated in one. If this theory holds, what evidence would we expect to see? Treasuries being sold off steadily over time, which has been happening. Money flowing out of paper gold products like US gold ETFs, which has also been happening. Gold overtaking treasuries as the leading reserve asset for central banks, which is now the case. And record gold demand in China, which recently hit 207 tons, breaking a record that had stood for more than a decade. Put it together and the picture is consistent. Prices diverging between physical and paper markets, the world reducing its paper claims, and gold flowing east. In fact, gold has been the single largest US export for several months running. Central banks worldwide are shedding dollar paper and quietly accumulating the physical metal. Does that look like a healthy, transparent market? This theory says no. There is one more data point worth mentioning, and it goes back to 2014, when the head of the Shanghai Gold Exchange spoke at the London Bullion Market Association, the Western institution that has long set the global paper gold price. He said that Shanghai gold would change the pattern of gold being consumed in the East, but priced in the West, and that once China had a real voice in the international gold market, the true price of gold would be revealed. That was 12 years ago. In 2026, the pieces appear to be falling into place. What China is actually building. So what exactly is China constructing? Essentially its own version of the gold market, one built so the house cannot quietly stack the deck. That is the real reason ICBC, China Construction Bank, and the others are all cutting off retail paper trading on the very same date, July 24th. That is not a coincidence, because in that same window, China is also activating the second half of its plan, a new gold settlement system based in Hong Kong, working in tandem with the Shanghai Gold Exchange. Here is how it fits together. Shanghai becomes the vault and the price setter, an exchange built around physical delivery, where trades require real metal to move, producing a price based on actual supply and demand rather than a mountain of paper bets. That is real price discovery, but China's capital controls make it hard for foreign money to access Shanghai directly. That is where Hong Kong comes in, acting as the front door. Shanghai sets the price through physical trading, and Hong Kong lets the rest of the world trade against it. Together, that forms a parallel financial system, an alternative to London and New York, operating outside the dollar. The scale of the build-out is telling. Hong Kong is expanding its physical gold vault capacity from around 200 tons to over 2,000 tons, a tenfold increase. You would not need vault space like that for a paper-only casino. You would need it if you intended to settle in real, physical gold. China's broader goal is straightforward. Whoever controls the price of the world's most trusted form of money and settles that trade in their own currency, gives that currency an anchor. Not a formal gold standard, but something that shapes expectations of stability. The yuan is not freely traded and remains tightly controlled by the Chinese government. So much of the world does not fully trust it yet. Gold, on the other hand, is broadly trusted. If major commodity deals can be priced in yuan and settled against real gold sitting in a Shanghai or regional vault, countries that were previously hesitant to hold yuan now have a reason to, because something tangible sits behind it, something that cannot simply be printed. What might the US do in response? Which raises the obvious question, how does the United States respond? One theory is that the US tries something similar with gold-backed treasury bonds. Here is a detail that sounds almost too strange to be true, but is accurate. The US government officially holds around 8,000 tons of gold. Whether all of it is truly unencumbered, or even still fully accounted for, is disputed, but that is the official figure. On the government's books, that gold is not valued at the market price. It is valued using a fixed price set by law back in 1973 and never updated since, $42 an ounce. Gold today trades around $4,000 an ounce, so officially, the U.S. values its entire gold reserve at roughly $11 billion, when at current prices it would be worth closer to $1 trillion. That gap has been sitting there since the Nixon era, hidden inside an old accounting rule. The U.S. could close that gap with a single policy change, revalue its gold reserves from $42 to something near the market price. Doing so would add more than $1 trillion in recognized value to the Treasury's balance sheet overnight, without issuing a single new bond. The Federal Reserve has actually published research exploring this exact idea, and Treasury officials have publicly discussed monetizing the asset side of America's balance sheet. There is also a related proposal from economist Judy Shelton for a 50-year Treasury bond redeemable in either dollars or physical gold, which would effectively make U.S. Treasuries partially gold-backed, the same basic move China appears to be making with the yuan. If China is anchoring its currency to gold, the American countermove would be to do the same for the dollar. Some speculation online suggests this kind of revaluation could land around a symbolically significant date, though nothing confirms that timeline. Whether or not it happens on any particular day, the Federal Reserve is studying the idea. Treasury officials have discussed it publicly, and the gold-backed bond proposal is a real, live idea in policy circles. And even if a formal gold revaluation never happens, a similar effect could still occur through a different channel, not gold rising, but the dollar falling. Gold does not need to go up in absolute terms for this dynamic to play out. A weaker dollar produces much the same result. A quick disclosure: I personally do not hold any gold right now. I am waiting for a better entry point, and when that changes, if this was useful, share it with someone who could use it. Financial education is one of the better things you can pass along. Thanks for watching. Like and subscribe.